$43.8 billion in total revenue suddenly triggered a massive 32% share price spike. Yet underneath this immediate euphoria, core profitability is quietly collapsing. Is the broader market entirely wrong about Dell Technologies, or is a hidden financial trap about to aggressively wipe out their recent gains? Looking closely at the sudden 88% year-over-year growth in total revenue, it becomes instantly clear why Wall Street panicked to buy the stock. The fundamental catalyst was an exclusive federal software contract value of $9.7 billion that completely altered its valuation trajectory. How did a legacy hardware provider suddenly command such a monumental modernization premium overnight? With artificial intelligence-optimized server sales hitting an astonishing $16.1 billion, the mainstream financial media blindly calls this a standard earnings beat. When total revenue shatters market expectations to reach that aforementioned $43.8 billion, the underlying business picture changes entirely. The golden rule in value investing dictates that explosive top-line growth only matters if it brings structural revenue permanence. For your portfolio, you must prioritize companies capable of converting fleeting technological trends into multi-year $9.7 billion government contracts. To truly grasp why this immense shift is happening, we must look at something seemingly unrelated to their currently realized sales figures. The pending artificial intelligence server order backlog currently stands at a towering $24.4 billion across their global enterprise divisions. A backlog is simply the total monetary value of official orders placed by committed customers, but not yet recognized as actual revenue. Why does Wall Street care so deeply about this pending order book, rather than focusing strictly on the raw cash currently sitting in the bank? Surface-level analysts might incorrectly argue this $24.4 billion backlog is just a list of unfulfilled promises, constantly worrying about global supply chain disruptions derailing these future sales. However, when you fully realize this massive order backlog essentially guarantees the near-term revenue pipeline, you begin to understand exactly why the stock spiked. As an intelligent investor, you must always deliberately distinguish between temporary cyclical demand spikes and massive structural backlog guarantees. The primary trade implication here is that $24.4 billion in forward order visibility provides a drastically stronger fundamental floor than backward-looking earnings reports. This realization brings us to the real elephant in the room regarding Dell Technologies, representing a hidden liability the broader market is ignoring entirely. Gross margins severely compressed from 21.1% down to a highly concerning 17.8% during the most recent operational quarter. Gross margin simply measures the critical percentage of revenue left over after subtracting the direct operational costs of producing the actual goods sold. How can a legacy technology company dominating the artificial intelligence revolution actually lose baseline profitability on the physical hardware products it sells? Enthusiastic market bulls falsely assume selling premium enterprise infrastructure automatically equates to capturing massive premium profits. The brutal reality is that a gross margin shrinking to exactly 17.8% reveals the dark, hidden tax of this massive technological boom. Dell Technologies relies heavily on expensive third-party component suppliers, meaning while overall top-line revenue is explosive, actual core profit extracted per individual server is quietly shrinking. This specific dynamic is exactly why relying on just one surface metric is incredibly dangerous for the long-term health of your portfolio. Unprecedented 88% revenue hypergrowth can completely mask a highly dangerous deterioration in a company's inherent pricing power. This specific margin insight is exactly what separates basic financial observation from truly elite fundamental analysis in today's highly volatile markets. If the core profitability of these physical hardware units is actively decaying, how did Dell Technologies officially deliver such an earth-shattering bottom line? Operating income surged an astonishing 214% year-over-year to reach an absolutely incredible $3.65 billion. Operating income accurately represents the actual $3.65 billion in profit a company generates from its core business operations strictly after deducting everyday operating expenses. How did the executive management team orchestrate this immense financial miracle while their underlying gross margins were actively bleeding out? When any heavy manufacturing company scales this aggressively, you naturally expect total operating costs to rapidly skyrocket directly alongside their surging sales. Instead, management boldly executed a masterclass in strict corporate efficiency, restricting selling, general, and administrative expense growth to a mere 6% against that massive revenue jump. This immense internal cost discipline directly fueled a staggering 282% year-over-year surge in earnings per share. Earnings per share is simply the specific portion of a company's total profit carefully allocated to each individual outstanding share of common stock. The ultimate fundamental analysis lesson here is that extreme operational cost discipline can temporarily rescue a structurally flawed gross margin trajectory. Moving forward, you must closely track exactly how long this 6% expense growth efficiency can successfully cover up fundamentally declining unit economics. This delicate balancing act perfectly sets up management's next audacious corporate move. The full-year strategic revenue outlook was aggressively raised to a massive midpoint of $167 billion. A cautious market skeptic might rationally think this lofty projection is overly optimistic, given widely known global supply chain constraints regarding advanced semiconductor availability. They utterly obliterate lingering institutional doubts. That massive forward figure actually represents an astonishing 144% year-over-year increase in segment revenue alone. By confidently projecting such aggressive forward scale, Dell Technologies fiercely signals they have officially secured the vital supply chain relationships required to fulfill this insatiable institutional demand. When a legacy hardware company dramatically raises its $167 billion financial outlook, the institutional market will aggressively reprice the stock immediately. However, promises of future revenue mean absolutely nothing if a company cannot financially protect its devoted shareholders today, which introduces our next critical metric. Dell Technologies enthusiastically deployed an incredibly aggressive $1.62 billion in open market share repurchases during the recent operational quarter. Why would a mature company currently engaged in a highly costly hyper-growth phase spend vital capital buying back its own stock? Traditional value investing strategy often dictates that excess cash should be heavily reinvested directly into research and development during a major technology boom. However, when you intelligently combine those massive stock buybacks with $464 million paid out directly in quarterly dividends, you suddenly see a masterfully constructed capital allocation flaw. Returning a massive total of $2.1 billion in pure capital to loyal shareholders unequivocally proves Dell Technologies generates highly liquid, high-quality cash. This consistent shareholder return program creates a robust psychological safety net that effectively terrifies aggressive short sellers and generously rewards patient long-term holders. For your active portfolio, this clearly signifies that when management puts $2.1 billion securely back into your hands, it fundamentally de-risks your overall investment position. Yet, before prematurely crowning this specific company the undisputed fundamental champion of the enterprise hardware space, we absolutely must expose a terrifying balance sheet vulnerability. The corporate accounts payable balance suddenly ballooned to a truly massive $45.3 billion in a single quarter. Accounts payable represents the short-term operational debt a company currently owes to its dedicated suppliers and vendors for physical goods, received but not yet paid for. On the optimistic surface, Wall Street is loudly cheering because core free cash flow remained technically positive at a seemingly solid $3.11 billion. Beneath that highly reassuring headline number, the actual free cash flow margin severely declined from a healthy 9.5% down to just a fragile 7.1%. Dell Technologies is heavily utilizing that massive $45.3 billion supplier liability specifically to aggressively fund its own rapid hypergrowth cycle. Any sudden, unexpected macroeconomic slowdown in their physical inventory turnover could instantly spark a severe, highly destructive working capital crisis. Actively using extreme vendor debt to creatively finance explosive corporate growth is an incredibly dangerous high-wire act that requires flawless operational execution. To gauge total health, we must also closely watch the commercial client segment revenue, which fortunately grew a solid 18% to officially hit $13 billion. This distinct segment performance solidly proves Dell Technologies isn't exclusively surviving on complex servers alone, but is heavily benefiting from a burgeoning enterprise personal computer refresh cycle. A truly balanced, deeply analytical investing strategy consistently accounts for both these heavily hidden balance sheet risks and highly diversified enterprise revenue streams. The breathtaking 88% year-over-year expansion in total revenue proves unequivocally that Dell Technologies has successfully cemented itself as the premier infrastructure architect for this global transition. However, their increasingly heavy reliance on steadily tightening gross margins and rapidly exploding vendor liabilities makes this a highly leveraged operational maneuver requiring absolute perfection moving forward. Can Dell Technologies successfully outrun these rapidly shrinking 17.8% hardware margins through sheer sales volume? Or is this massive supplier debt a ticking financial time bomb? I want to know exactly what you think about this critical balance sheet vulnerability. So let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.